Hi everybody. Good morning. So I think we'll start. We have a quorum of more than 100 guests who have joined. I'll just lay down the agenda for today's webinar. So what we want to cover today is how the market has shaped up in the last 12, 18 months. What are the reasons for the events that have unfolded and where we are today? And then we also want to cover how the markets would likely unfold in the next 12, 18 months. What are the likely events? And we'll go deep dive into that. Uh, uh, I'll I'll just quickly introduce myself also. I'm Jigme. I'm one of the early members to join Deserve in 2021. I've been with the business for the last 4 odd years now. Overall, have over 20 years of experience. I have previously done wealth management across institutions like Citibank, IIFL Wealth, and I'm also an alumni of IIM Codicode. With me, I have Sushmit Patodia today. Sushmit is our group head of business and new initiatives. Sushmit has been a fund manager in his erstwhile organization, Motilal Oswal, where he was there for managing money for over 8 years. Most recently, he was with Antler, which is a global venture capital fund. So he was there for 3 years, making investments across different domains. Sushmit has overall 20 plus years of experience and also is an alumni of IIM Bangalore 2005 batch. I'll request Sushmit to sort of take over and
Great. Thank you so much, Jigme. I hope you can hear me. I'll start sharing my screen. Can you see my screen, Jigme?
yeah, we can see a screen.
Awesome. So thank you so much. We'll probably spend the next 25 to 35 minutes covering uh, these four agenda items. The first is what's happened in the last 12 months. Where did we see the slowdown coming? How did the slowdown happen? Markets have been flat, nearly flat for a year now. Uh, and the second is what is changing. We at Deserve think that something significantly, fundamentally is changing both from the government side and the Reserve Bank side. So we'll take you through that. Third, something that we want to capture every time when we do these webinars is there are some basic truths about equities that we want to leave you with. And it'll help us stay invested in equities for longer if we understand and internalize some of these things. And last is what is our recommendation? As they say, I get all this, but what do we do now? So we'll cover all these four in the next 25 to 35 minutes. Let's get started. So what happened in the last 12 months? Markets were flat. So this is something that's very interesting that we could put together for you. We saw a significant fiscal slowdown, which is the government spending came down by 190 basis points as a percentage of GDP. So if you assume that the nominal GDP growth rate of India was about 11%, there was a headwind of 190 basis points owing to government slowdown. The first one is fiscal tightening, which is uh, we are on a glide path of fiscal tightening. So 80 basis points came from there. Very interestingly, GST compensation. Typically what would happen is the government collects something called the GST compensation cess in the indirect tax, and that gets distributed to the states, and they in turn used to spend it. But in the last 12 months, the government had some borrowings towards which this was spent or the loans were repaid. So you could imagine from since GST was introduced, this GST compensation cess was actually returned back to the states. But in the last 12 months, this was used by the government to pay down the arrears that the government had in loans. And third is the banking credit slowdown. 16% credit growth came down to 10%, which had, using no multiplier, had a straight 40 basis point impact on the GDP. Our GDP was hunkering along at about 11, 12%, and we had this headwind. Combined with this, we also had a monetary slowdown. If you remember, RBI started tightening the regulatory framework back in October 23, which is almost 2 years from past, where they started raising risk weights on unsecured and consumer lending. and they also felt like that space was heating up. So they ensured that the banks have to park an extra 10% as incremental CRR. CRR is cash reserve ratio that the banks hold with the RBI. This led to the entire banking system going into deficit liquidity mode. And we are a capital starved country. So whenever the monetary goes into deficit liquidity, lending becomes tighter, and credit availability comes down. So we ran into a 3 lakh crore deficit, which led to significant scaling back of lending, and that's what we covered when the credit growth came down. This was also accompanied by the wave of FPI selling, which led to INR depreciation, and RBI had to sell nearly $60 billion to ensure that the rupee is defended. All this played a part, and corporates put capex plans on hold. Credit growth became tough, and there was a fiscal slowdown. So the last 12 months have been extremely challenging, and for the country as a whole, and that we think is what played out in the earnings as well. If you look at coming out of COVID, we had extremely strong earnings trajectory. We were running at 16 to 20% in some quarters. This is quarterly earnings growth for Nifty. We were running extremely hot, but somewhere, as you can see, October 23 onwards and then April 24 onwards, tightening started, and you saw the earnings growth Y on Y coming down. It takes about 3 to 6 months for any of these measures to play out. So, what started from by RBI in October, by the Government of India in April, started playing out in June, September onwards. And, you also had very, very high base. As you can see, the June 23 earnings growth was 25%, uh, while the June 24 earnings growth was 8% and so on. Interestingly, if you now think about it going forward, the base is now much benign compared to what it was a year ago. Uh, Markets are a slave of earnings, both in the near term and the long term. So very interestingly, if you look at market returns and PAT growth, this is a very interesting table in FY20. Yeah, obviously, FY20 we ended with COVID, unfortunately. So the earnings decline was 9%. Nifty 500 return was minus 28%. And as earnings kicked in, so did the Nifty 500 returns, right? And In FY25, the PAT growth was limited to 6% and Nifty returned near zero. What happens in the long term? Sometimes it's good to take this is like a 30-year chart of Nifty earnings. Good to take a view which is long term. Very interestingly, there are periods of growth and periods of stagnation of earnings, and we've tried to divide this. So if you look at from 1997 to 2003, we hardly had any growth. We had the East Asian crisis, we had the dot-com bust. So the Nifty EPS growth was 3.5, CAGR was 0.2. 03 to 08 was the boom period. Most of you may have lived it. Our Nifty earnings growth for 5 years was 25% and markets returned 37%. 08 to 20 was, multiple things happened yeah, in our country. We call it the reform period. We introduced almost everything in this period, right? All the way from GST, IBC, income tax rationalization, Aadhaar, UPI, I mean, you name it. And those measures were introduced then, and that led to significant slowdown in earnings. In the last 4 years, coming out of COVID, again, we think Nifty EPS growth was 16% and Nifty returned 22%. This year, FY25 was a speed bump. We think the next 2 years we will catch up again, and this is consensus earnings. Consensus earnings points towards a 15% CAGR growth. So that's summarizing what happened in the last 12 months. We had both a fiscal pullback from the government of India, almost contributed to 190 basis points of lower GDP growth. And RBI not only tightened lending norms, but also had to defend the rupee, because of which we had lending cycle come down.
So Shwet, just want to inform the guests who have joined the call. There is a Q&A section where you can post your questions. and we will sort of spend 15 odd minutes in the last to sort of take those questions. So please do put your questions there. I missed talking about this at the start of the session, but request everybody to please put your questions in the Q&A section.
Thank you, Jigme. So what's changing? Both RBI and government have what we call fired salvos for getting back growth. If as we had discussed, we saw a significant liquidity deficit, and RBI has infused about 10 trillion rupees, which is 10 lakh crores into the system back, because of which now we have liquidity surplus, which means the banks will be more comfortable to lend going forward. Uh, Secondly, RBI announced CRR cut. CRR is the cash that the banks have to keep with RBI. So whatever cash that they keep with RBI is not lendable, which means that it is kind of, you could call it debt capital or safety capital. That was taken up to 4.5%, and there has been a staggered cut. So by the end of this year, which is December 25, this will be back to 3%. Now, this is the lowest that we have seen in a very, very long time if you remove COVID, right? So this will give more flexibility for the lenders and more room for the lenders to lend. Second is government. What's government done? And very interestingly, this number is very, very similar to the pullback that the government did. The first is the personal income tax relief. All of us are beneficiaries of it. They have increased the tax slabs. We estimate the benefit of that to be about 30 basis points for the customers. Secondly, what is the the whole GST rate overhaul? That adds about 30 basis points as well to the GDP. Just for the people who are interested, the GST compensation cess is the similar amount to which the GST cut has happened. So a lot of people have raised concerns that this GST cut will lead to increased fiscal deficit or increased borrowing by the government. That's not the case. The compensation cess that the government doesn't need anymore is what is plowed back into the GST cut. The third is the eighth pay commission that has got a little delayed, but it's coming up in Jan. It's an additional payout of about 2.5 to 3 lakh crores. That's about 1% of our GDP. So we believe that, and as we saw that everything has a lag effect. So while the government starts tightening, the monetary policy starts tightening, it takes about 3 to 6 months for it to play out in the economy and the earnings. And so does it work in the reverse as well. When you start loosening, or when you start giving back incentives, it takes about 3 to 6 months for it to show up in earnings and growth. So we believe that all these initiatives taken over the last 2 to 3 months will start playing out in the next 6 to 9 months, both in earnings, and hence we believe should show up in markets as well. Uh, Having said that, the one thing that we do want to point out is, despite the earnings slowdown, why didn't the markets fall, right? And I think this is something that we need to understand. It also could explain to you why valuations of India are a little higher than most other markets, and I'm sure you hear about this all the time. Just give me 30 seconds to explain this to you. So the blue line that you see is the amount of domestic flows that we get as a percentage of total market cap. As you can see, whether it's the SIP revolution, whether it is the mutual fund revolution, we believe that this number will continue to inch up, right? So, incrementally, 1% of the total market cap, 1 to 1.5%, is now getting invested as fresh flows, right? So that leads to more and more demand, and supply is difficult to catch up, right? While we have a rush of IPOs going on right now, I don't think this is something that happens all the time, right? And it also helps absorb the FII selling when they have to. The second is the red line is our GSEC yield, or the 10-year government borrowing rate, right? The rate at which the government borrows. As you can see, this has come down from 7.3% to 6.6%. Again, if you take a 15-year view that this chart represents, we are at the lower end of this lower end of the range. Now, this is also the reason whereby which the P's remain elevated, right? Because think about this, right? If you are an investor, which most of you are, and you have an option to either put money in fixed deposit or real estate, or even gold right now, or equities, right? The easiest to put money is in equities or fixed deposits or bond, and the post-tax bond yield in India now, or post-tax fixed deposit yield, is now about 5%, right? 4 to 5, depending on which bank you choose. Uh, and Which means that the alternative equity has to give you much lower return for you to choose equities over debt, right? So if the fixed deposit was 15%, then you would expect equities to return 20%, right? But if the fixed deposit post-tax yield is 5%, you could be happy with 8 to 10% from equities, right? And that keeps the PE elevated. So this is very, very important. Whenever someone says that the valuations are always expensive in India, the valuations are always expensive because the post tax interest that I get from a fixed income is significantly lower than what equities return even today. Uh, this is an adaptation of what Mr. Warren Buffett keeps saying. He loves to look at market cap to GDP as a good metric of whether the overall market is uh, is expensive or not. We believe that we live in a relative world, and it's better to look at India's contribution to world market cap and India's contribution to world GDP. So if you look at India's contribution to world GDP is about 3.5%. We are close to a $4 trillion economy. The world is about $120 trillion of total GDP. So the contribution is about 3.5%. Our market cap contribution to the world is also about 3.5%, which means we are, if you were to think about this from this metric perspective, we are as expensive or as cheap as the world is, right? So obviously we had spiked to 4.5, which seemed a little extra, but we are now back to very similar levels to where our contribution of GDP is to the world. To summarize, we saw significant fiscal and monetary tightening over the last 12 months, because of which earnings slowed down, and that led to markets being flat. Both government and the central bank has significantly changed stance. Uh, you know, Whether it is uh, the whole fiscal being put back from a GST, income tax rate cut, pay commission, or even the central bank, which has infused significant liquidity and cut CRR, the cash reserve ratio for the banks. And in the last RBI meeting, they also announced easing of lending norms for corporates, right? Earlier, corporates had challenges of uh, financing M&As for large corporates, so that has also been eased. So, you can now sense that the government and the central bank are trying to do everything to ensure that the growth is back. Uh, that really does hold us in good stead. I think every entrepreneur wants to grow. If the environment is good, then it becomes easier for entrepreneurs and businesses to grow. Coming to a few aspects that we do want to highlight, and how this goes more towards behavioral finance, which is how do we think about equities? Some of you may have SIPs for the last 1 or 2 or 3 years, which may not be more than 5, 6, 7, 8% return. So, we thought that it'll be worthwhile to even touch upon what's happened in the past, and how do we think about that in the future. Uh, so this is, I would say, one of the most interesting aspects of equity markets, which is underappreciated. The 25-year multiple, right? If you take Nifty 500 total return index, 25-year multiple is about 34 times, which is 25-year return is 15.2% CAGR, right? The interesting thing is you never make 15.2% in any year, right? That's the beauty of equity markets. And it takes it takes our brains a lot of time to figure this out, because we have been taught to be linear about it, right? Especially when it comes to math, 1 plus 1 is always 2, but in equities, 1 plus 1 is 2 over the long term. So just to give you some data point, number of times, so this is about 8,000 instances that we have documented. The number of times annual rolling return is between 14.5 and 15.5. So 15.2 you never get, right? Now, so we said, okay, let's broaden the range. 14.5 and 15.5 is only 3%, right? So most of us, whether we are wealth managers or fund managers, we always come and tell you expect 12 to 15% return in equities. But what we don't tell you is you will never get it when you for a 12-month period, right? You will get it over a period of time, but it is only 3% of the times you will see it where your 1 year return is exactly 15%, right? So that's something that is super interesting, and that's also what makes it a little tough to make money in equities, because we get in saying that we're going to make 15%. After 1 year it's 5, the next year is 25, third year it's 0, and then it kind of starts messing with our mathematical brains. The other interesting thing is, it's not linear, right? If you take 20 to 25 years, uh, out of the 25 years, only 187 months were positive returns, and 113 months were negative returns. Which means, imagine if you do your portfolio review with us every month, every 2.5 months, or every second month, or every third month, you are going to feel not good about the review, right? Because your money would be lesser than the last review. So that's what makes it challenging, again, to stay invested. But this is, again, see, these are facts of the market. These are some things that, what they say, that what has happened in the last 25 years is likely to happen in the next 25 years, right?
So
So
Sushmit, like in 25 years, there are basically 300 uh, periods, right? So you're saying out of the 300 periods, there have been 40% of the time when markets are negative, right?
yeah,
Right. And so 60% of the time. So you have a 3:2 or 2:1 ratio
yeah.
of being positive, and 30% of the time you could be negative.
Yeah, yeah, yeah. Thanks for that. So I think that's something that's, again, every third month, you should expect it to be a not a pleasant statement to look at. The other thing that we wanted to dispel is, most of us come and tell you equities is for the long term, equities for the long term, but I don't think we explain why equities is for the long term. The biggest reason is this, right? At the end of the day, whether you're buying a mutual fund, whether you're buying direct stock, you are buying a company slash a part of the business. You're buying ownership in a business. If you have, most of us are working, or most of us run businesses. No businesses work in a straight line, right? They have their ups and downs, cycles, sometimes government, as we saw, cycles of central bank, as we saw, global cycles, as we saw. Right? There are multiple people cycles. There are so many cycles that play while you're running a business. Uh, but over the long term, if you pick the right businesses over 5 years, those businesses should do well, right? And this is exactly what plays out in the markets as well. So if you look at the rolling returns, which is basically, we've taken 25 years data again and said, if you held something for 1 year, right? If you held the index for 1 year, what is the possibility of you making negative return, right? Which is 38% of the time in the last 25 years, you had the you had the probability of making negative returns. As you can see, this number keeps reducing, almost goes to zero if you held it for 5 years. In fact, I looked at this data, and the whole 5 years, all the instances, which is about 5 or 6 instances, happened if you had bought in 2007, and in the peak of 2007, and you held on for 5 years, you made negative returns. Apart from that, there is no period in the history of the Indian markets where you made negative returns if you held something for 5 years or more.
So 2007 was the global financial crisis. I think that is the sharpest decline that global markets and even India has seen in the last probably 30 years. So just to add on.
Yeah. So, this is the reason that we keep saying that stay equities for the long term, equities for the long term, because the probability of making money increases as you stay longer. And why does that happen? Because we own parts of businesses, and businesses over long periods of time should do well, but over short periods of time could have volatility in their own performance. Uh, this is just one more thing, which is, this is a piece I'd written a few years ago, and which is, people always tell us that I think the markets are looking bad, and I want to sell, and I want to come back, right? I'm sure most of you have thought about this. I have thought about this every day almost, but whenever I think about it, I see this chart and I get reminded of this, right? Which is, if you look at the Nifty 30 years return, as we discussed, is about 34. This is excluding dividends. So 34 times. If you missed only 10 days, right? Only the best 10 days of the market out of the 60 to 100 days, your return would come down from 34x to 12x, right? And if you missed the best 30 days, right? So just imagine 30 years, 360 months, you missed 1 month of the best returns, your return would come down to 3x, right? And the best part is in this that, mm, as you can see, 4 out of 12, sorry, 4 out of 10, 11 out of 20, 16 out of 30 days were the bounce after the fall, right? What we call the bear market days, right? Which is when the market bounces after it falls. We saw this in COVID. We saw this during 2007-8. We saw during this 2000 crash. We saw it even in 2017 NBFC crisis. When the markets bounce, is also a very, very important constituent of making returns. So almost you could say 40% of the best days of the markets are actually markets coming out of a bear market or a crisis. So imagine the task you have to do. The task you have to do is not only sell at the top, but to ensure that you also buy it at the right bottom, because you cannot miss the bounce. So I think this is something that, again, Mr. Buffett taught us, that sometimes money is also made when it goes from gruesome to bad, and or as he calls it, gruesome to bad. We say very bad to less bad, or rather than from great to greater. Right? So again, it's this is also the reason why we request investors to stay invested in equities, do SIPs, because then you can capture these bad days as well. Be systematic in your investing. Uh, just the last part, which is how do you, the markets are a changing organism. So very interesting. These are the top companies, top 10 companies of our country over the last, again, 20 years. As you can see, change is the only constant. The top 10 in terms of market cap keeps changing. There are two or three which remain constant, but apart from that, it keeps changing. One of the things that I wanted to highlight as the change is, the Bharti and the TCS. It keeps surprising me and keeps staggering me. 4 years ago, Bharti's market cap was 3.8 lakh crores, or 3,80,000 crores, and TCS was 14 lakh crores, right? Today, Bharti is 12.4 lakh crores and TCS is 11 lakh crores, right? Both are great companies. They were great companies 4 years ago. They're great companies today. But you need someone to do this full time to take advantage of this change, right? This kind of and this is significant value creation, right? I mean, imagine if you were able to, if a fund manager was able to make the switch from TCS to Bharti. The outperformance that we would have got was ridiculous, right? So because it's changing so much, it becomes very, very important that somebody does this full time, right? And this is why we believe that there is a difference between doing fixed deposit investing and mutual and equity investing. I have been an equity fund manager, direct equity fund manager for a long time, with one of the best houses, and I can tell you that it is not a 12-hour job; it is a
Yeah,
24.
so I would just request you to sort of give your experience, right? Having been a fund manager yourself, how difficult is it for you to sort of, I think, decide and take decisions versus, I mean, not
Uh,
doing the job on a day-to-day basis?
No, I think unfortunately, the joke used to be in when we were there back in fund managers, that the fund manager does not, anybody can become a fund manager. You don't need a degree, right? Not anybody can become a doctor. You need a degree. Because anybody can become a fund manager, everybody becomes a fund manager. But let me tell you, this is a full-time job, right? I mean, we were glued on 24/7, not because we were trying to track every day everything, but there was just so much happening, right? Just imagine if there are even 100 companies you have to track as a portfolio manager. uh, you have four times the results come out in a year. You have one annual report which comes out in a year. So 100 into 500 things you have to analyze in 365 days, right? So even if I don't make any decisions, assuming I take about half a day to analyze, I already spent 250 or 365 days just reading and analyzing. Forget action, forget execution, forget all that, right? So it's quite a full-time job, and this is again just a reflection of why it's a full-time job, right? So one of the things we want to do this in this webinar is to kind of explain to you, a lot of you have heard, you know, don't do direct equity, do mutual fund, but we're trying to get into the second layer, which is why do we say this? So just tying all this together, what's our recommendation? Uh, I'm sure we were going to be asked this, so we put this slide right up front, which is what do we like? Four things that we like, four themes that we like. Uh, in India, it's difficult to pick sectors because sectors are all like a lot of companies do a lot of things. So we pick themes. Consumption, we continue to believe that consumption is going to it is 60% of India's GDP. It will continue to be the largest contributor to our growth going forward. We are a country which is going from practically a poor country to a middle income country. I don't know if you know this, but we had more poor people than non-poor people in India until 2 years ago. Over the next 3 years, we will have more non-poor people than poor people, right? It's a significant change that happened. uh, Second is financialization. More than 250 people on this webinar is a good example of what we are seeing. Financialization uh, allows savings to be multiplied, right? Or to be used multiple times. Investment in real estate or buying house is a kind of a dead investment. So I think savings explosion. Just to give you one data point, maybe we should do a webinar just on savings at some point. Over the last 25 years, as a country, we saved $12 trillion. In the next 25 years, we will save $100 trillion, right? It's quite, this is when the country goes from becoming middle income to upper middle class or high income, this is the kind of pool that gets generated. Third is urbanization, and this is something that is we sometimes, most of the times, we bear the brunt of it. Especially we are in Bangalore, so I can tell you we have more cribs about urbanization than benefits. And but having said that, this is again moving away from villages. Villages, the way they're structured, are less productive. And once you move to cities, your life becomes more productive. You start using more organized services. Urbanization is a very, very big aspect. Just again, one quick data point. For the first time since independence, India's number of villages, as reported by census, went down 2 years ago, right? So, and obviously, the number of cities keep coming up. Uh, Small things like the Udan scheme, where they connect small cities, is a big fill up for smaller cities to become mid-sized cities. Last is digitization. We continue to believe that what started with Aadhaar, UPI, GST, so on and so forth, ONDC, UEI now. I mean, these things are very, very important to amplify output, right? It is critical. US had the railroads to amplify access. And Europe had great roads where they could send goods across each other. But even today, it takes 3 days to transfer money in the US, right? In India, we are lucky that we have digitized a few aspects. Obviously, we could do better with our physical infra, but I think our digital infra is world beating, right? I mean, it's completely world beating. You can start all the way from telecom services to all the way to transferring 50 lakh rupees online. It's on the touch of a button.
Sushmit, I think I just request you to sort of spend a little bit more time on financialization, right? India as a country, I think we are always credit starved. How credit with the new age fintechs who are able to lend to SMEs, right, at a click of a button, how that has revolutionized and how that will, I think, play a significant, because at Antler, because you're a VC there, you would have seen it upfront, right? How that is changing.
Yeah.
Maybe spend a
Yeah.
minute, please.
Thank you. Yeah, thank you for that, Jigme. So I think the biggest change that's happening is has was first was Aadhaar, obviously, right? Aadhaar enabled all of us to open Demat accounts in 30 seconds, right? I used to be in broking when opening a Demat account required 15 signatures, right? Now you can open a Demat account in 30 seconds, uh, thanks to mobile plus the Jam Trinity, as we call it. Then came GST. GST took a long time to stabilize, but now that it's stabilized, uh, if you combine GST and e-way, right? Both, by the way, both these information, if you are an entrepreneur, you can get this using APIs. Uh, if you know you if you combine GST information, you combine e-way bills, you combine what the whatever reports that are available in MC of the company, you could actually come up with a logic where you could figure out what the company is doing or what the SME is doing, uh, completely using automated machine learning, and give out a loan or give them at least eligibility of a loan in 30 seconds, right? That's the power. So that's the power of digital, which is which because of which financialization could happen, right? India has always had people wanting to borrow money to grow, but we've never had a way to profitably give them money, right? Uh, it is, in the earlier avatar, it is very difficult. I'm sure, you've seen, or banks have prided themselves saying, "Ki we go and sit with the SME, we figure out what their net worth is, we sit in their shop," and so on and so forth. Uh, while that is great, but that is not efficient, right? You can't scale. The best way to think about this is the number of demat accounts was 50 lakhs when it was not digital. It is now 20 crore, 25 crores when it is digital, right? So I think that is the way to think about this. Financialization uh, will explode if it has the digital component to it, right? And then we have the smartest of entrepreneurs trying to help our country grow in this. Uh, uh, I'll be mindful of time. So maybe the last couple of minutes before we start getting questions. Um, as we explained, it is a full-time job to be a fund manager, and we really think that mutual fund sachi mein sahi hai. It is not just an ad campaign, and just very, very simplistically put, why are they sahi, right? I mean, first of all, we have no doubt in saying this, that mutual funds are blessed, right, by the government of India, by the regulators, by everyone. And just to like put this into context, why do we say this, right? Um, compare MF to any other equity strategies that you can do. The tax on capital gain, tax on dividends, fee set off, everything, right? Everything is tax free, right? So the typical cost of a direct mutual fund is about 50 to 75 basis points. And if you take any other way of investing, is about 2.5%. Even if you do direct stocks, even if you do a good job of it, by the time your total, if you take a 5 year period, uh, the total cost that you will incur is anywhere between 80 to 120 basis points, right? So, the government has blessed an instrument, or an industry, and it is available to all of us, right? So that's why we believe that uh, having the best way to invest in our equity markets, in our growth story, is through mutual funds. So, if I can invest in mutual funds, why do I need Deserve? Why did Deserve start, right? I mean, frankly, and I think this is something that we don't talk enough as a firm, and I think this is very, very important. Again, it's part of uh, us. We have seen a lot of our clients go through this, right? A lot of our clients struggle with this. Just to give you a number, the average of number of schemes that our clients have, and we manage over 15,000 crores of assets now, is about 42, right? So you can imagine the proliferation of mutual funds that have happened. Uh, so today, we have come at a point in time in India where we have more mutual fund schemes than stocks, right? Uh, I also had the privilege of working in India's first ever private sector mutual fund back in 2002, and that time, we used to say, we have mutual funds are here because there are too many stocks now in India, right? So you need a mutual fund, you need an analyst, you need a fund manager. Today, about 25 years down the line, we are at a space where we think that there are too many mutual fund schemes in India, right? And do you need an analyst for it, right? We believe at Deserve that you do need someone to help you with this, right? And we had about, we have, there are at least registered 25,000 equity analysts, and I think unregistered, put all of us, every demat account holder is in a way an equity analyst in India. So we have 20 crore equity analysts in India.
This is direct equity analysts.
Yeah, direct. And we have 1,900 stocks, but we have no mutual fund analyst, right? The only mutual fund analyst available to us is sorted by performance, right? Maybe you could call Value Research or Morningstar to be two mutual fund analyst houses. But apart from that, we really don't have any mutual fund analyst. And this is really the genesis of Deserve, which is how do we help our clients to invest in the best instrument with analysis and research. The second thing, and if you speak with the founders, Sandeep, Weber, and Sahil, they will talk about this extremely, extremely in high regard, which is transparency in money management is probably the most important thing. I also believe in it. I've felt this. I've seen this. I think mutual funds have scaled because they are transparent as an instrument, right? Uh, if a NAV gets printed, you will get that. If you and you put in a redemption request, you will get those many units back, right? It's as simple as that. So I think transparency is something that we uphold in everything that we do at Deserve. Uh, just last slide. So this is what we've been able to do. We run a fund of direct mutual funds. It's just completed 3 years. It is now the second largest fund of fund in India, investing in mutual funds. We are just crossing the 5,500 crore mark. Since inception, we've been able to deliver 18.24 returns, and which is, you know, sorry, since inception, we have delivered 20.11% return versus benchmark of 18.32. The thing that we are really proud about is the down capture, which is if the markets fall 20%, we would fall 15%, right? 75%. And I think that's something that reduces or that allows investors to stay longer on the journey of compounding. And Because if you see lower drawdowns, it becomes easier to stay invested.
Thanks, Sushmit. Sushmit, and also I think one thing that we don't talk on enough about running a fund of fund on mutual funds is that scale or size of the AUM. So today ERS is more than 5,000 crores, right? Size and scale of AUM of the strategy is never a constraint, right?
Yeah, absolutely. And this is something that we have debated in boardrooms of various asset management companies, which is uh, you know the challenge with the PMS of direct equity is that it is extremely operationally intensive, right? And that's why you see that none of the PMSs in India have scaled beyond a point, while managing a mutual fund of fund is that much easier because I mean purely from an execution perspective, not from anything else.
Cool. Thanks so much, Sushmit. So we have over 65 questions that our guests have sort of raised to us. What I've tried to do over the last 5, 6 minutes is try to look at which are the repeated questions. So there are a lot of questions, Sushmit, on I think today tariffs is a very important and relatable topic, right? A lot of questions on tariffs, a lot of questions on what is happening with gold and silver, a lot of questions on AI. So let's take like maybe you could talk about tariffs first. What is happening? What do you think? How is it playing out? How will it play out? How is it going to affect India and our portfolios?
Yeah. So tariff, I think, I mean, frankly, it's one tweet which changes the world around tariff. But, the only thing that we are looking, what we've been observing and looking at is, uh, is this, right? Which is what does Mr. Trump tweet and what is the final draft of the regulation or the circular that comes out, right? At the end of the day, tweet dictates market sentiments, but tweet does not dictate businesses, right? So the classic example is H1B. If you remember the whole H1B visa fiasco that happened with that tweet, we kind of, people were jumping off flights, deboarding flights, and whatnot, right there. Like it was so sad to see what was going on. But when the final circular came, it was the impact was 1% of almost what was tweeted out. Correct. And so I think now, and see, markets, as we said, are a learning organism. Uh, they will continue to learn. And, markets have now learned that tweet to final impact of the circular is maybe the magnitude is significantly different, right? So you will, in fact, I won't be surprised if you start seeing markets being a little more benign towards tweets of Mr. Trump, right? So I think that is point number one, which is, it is easy to say something, but difficult to pen it down and then make it a circular. The second, now coming to the details of the tariff. See, again, in India, we are quite lucky that our exports of about $250 billion of services is outside, it's kept outside this gamut, right? so far. Uh, and the best part is that the five largest companies of the US uh, have Indians either at the very top or at the C-suite level, right? So I think somewhere that if $250 billion of IT exports are protected, then I believe that the tariff impact will be extremely limited. So you take out IT services, you take out pharma, uh, that is majority of our exports. The two sectors that will get impacted or looks like they're going to get impacted are textiles and gems and jewelry. Now, there's a very interesting uh, uh, thought on textile as well, which one of the experts made very recently, which said that you need people to make textiles, right? Textile is not like you put in 20 factories and you can get up and running. Uh, so about 2 lakh people would be needed incrementally if you assume tariffs to have the full impact, right? Which is Indian exports goes down for the long period of time. Where will you get those 2 lakh people, right? Uh, how many people can Bangladesh supply? How many people can Vietnam supply? How many people can Sri Lanka supply? Right? It's easy to say. I mean, it's the markets will put this into one Excel sheet, one cell, and say stock should be down 25%. But businesses don't work that way, right? So I think textile, and the second is gems and jewelry. I think that sector will see an impact. And same employment. Where will you get such a large workforce of employees to substitute, right? You may have a near-term short. How will you get? So I think and in a very uh, sad manner, both these sectors have extremely low representation in the markets as well, right? Textiles and gems and jewelries put together account for less than 2% of India's market cap. So, while it will have an impact on employment, I don't think it will have that serious an impact on the markets.
No, Sushmit, thanks so much for that. I think trying to correlate two questions and like IT, how tariffs affect IT India, right? And sort of you could correlate that with how AI is sort of affecting the world. As we see and read, and I'm no expert, but India has very low representation of the amount of work that is happening in AI, right? I think the two leaders clearly are US and China. US obviously is far ahead, but China, I think, is sort of doing a lot of innovation there side. If you can share your views there, that will sort of help us.
Yeah. Yeah, again, I was very lucky to be very, very close to the AI revolution thanks to my tenure at Antler. We have backed, one of the largest AI companies there, based out of Stockholm. Uh, I think which country doesn't want to be at the forefront of any technology, right? Forget AI for the time being, any technology. So if you go back to 1996 to 2000, India was not at all at the forefront of dot-com technology, right? It was the Qualcomms, Nortels, Cisco's of the world. But if you ask me who's been one of the biggest beneficiaries of dot-com slash internet, it would be India, US, and China, right? Uh, uh, so we will be deployers slash adopters of technology, right? And we will make money out of it. We have created a $250 billion annual export machinery
Yeah,
out.
yeah. I think you should just double click on that, Sushmit, and also sort of double click on this and what is the government doing today? I think government is sort of investing a lot of money with buying GPUs and sort of giving.
Yeah. Yeah. So, in AI, I think similar thing will happen. We will not be in the forefront of building the language model or the transformer or the GPUs or the chips, right? But whenever AI settles and we're able to find use cases, right? And how to use them commercially, and deployment of that into large corporates, into our own lives. That will still need people to do it, right? It may need fewer people, but it will still need people to do it, right? Just okay. Let me give you one more data point on this, and I hope it kind of helps you imagine. Uh, which is cloud. All of you have heard of cloud services or servers moving to clouds. That has been around for now nearly 20 years, right? Or maybe longer, actually, 25 years. The only even today, only 30% of enterprises are on cloud, right? So, enterprises take a lot of time to adapt, and that's where you make a lot of money because you help them adopt it or, align their organizations to it, right? India has been one of the largest, beneficiaries of this transformation from, on-premise servers to cloud servers. And I think this will continue. And this is how we think AI will also play out for India. Uh, we may not have a $5 trillion product company, but can we have a $1 trillion AI services company? Why not in the next 5 to 10 years? Right. That's the way to think about yeah.
So thanks, Pushpet. I'll try and squeeze in as many questions as can, and I think there are a lot of questions on gold and silver, and we'll try and take two more questions after that,
Yeah.
keeping in mind the time that we are on.
Yeah. So I think gold. We had an internal presentation on gold and silver. My compliance has said we cannot share that, but effectively, what we think. I'll again, there is a lot of narrative around gold. There is a lot of, but the facts are sometimes different from the narrative. As Mr. Damodaran says, narratives and numbers sometimes diverge. So just to give you. Some data points, and then we can come to how do we think about gold going forward. All of you have read that central banks are buying gold, right? That's been on the news for some time. It kind of caused a rush as well. Uh, but what are the numbers, right? So the gold holding by central banks is about 32,000 tons, right? Uh, so far, so this data is available until August, sorry, until September. Total gold that these central banks have bought this year is only 160 tons. Okay, 32,000 tons they have in holding, and all they have bought this year is 160 tons, right? Now you can imagine that it is not at all a big deal. On an average, central banks all over the world buy 500 tons of gold a year, right? So they are pretty much on average, if not below average, if you ask me, right? Uh, the other interesting thing is the three largest buyers of gold, right, are actually less than $1 trillion economies, right? They are not China, they're not India, right? They're Poland, Kazakhstan, Azerbaijan, right? These are the three largest buyers of gold, contributing to 60% of the gold buying, right? So not every central bank is going out and buying gold. Point number one. Uh, so that's the narrative and the number divergence. The second thing that we want to highlight is see, gold is what we call a fear asset, right? When you're uncertain about things, when you don't know what's going to happen, you go and buy gold, right? We think that this has been now a significant fear owing to Trump tariffs that happened over the last 6 months. We don't think this will continue, right? And once the dust on tariff settles down, we should get better when it comes to the whole gold aspect of it. Uh, Thirdly, we have a very interesting chart. Let me see if I can pull that up. I'm sure that chart is absolutely okay to show. Just give me a second. So basically, that shows that gold, we are at the amount of ounces does it take to buy a Nifty, uh, you know, is at the bottom end of its range, right? Which basically means that gold equities has never been cheaper relative to gold, right? I think that is again a very, very important
So,
way.
Sushmit, I'll ask, I think, a question which a lot of clients would have in their mind, right? Given that we've seen the rally in gold, right? What does somebody do now, right? Does he add more? Does he hold? Does he sort of book profits? I think that is one question that uh,
Yeah. So I think the most important thing is to first stick to your asset allocation. Whatever asset allocation that you have decided, which is, let's say, if you want to have 5% in gold and silver, and it is at 5%, don't do anything, right? But if you want to have 10% in gold and silver, and if you're at 15%, we would strongly recommend that you do book some profits, bring that 15% back to 10%, right? So I think that is what we would say. which is bring that 15%, whatever. So gold is up, like let's say 40%, equities are flat. So if you had asset allocation of 5% in gold and let's say 10% in gold, 90% in equities, 90 remained 90, 10 became 14 or 15. Bring that 4 5 back, put it into equities, and keep the rest 10% in gold.
Cool. Thanks, Vishmet. I think I'll take
Yeah.
some questions.
Yeah. No, Jigme, we can take more questions if there are.
Okay, yeah, yeah.
Let's
So
let's answer as many questions as we
let's
can.
take two more questions. I think some portfolio decision making questions that our guests have shared. One is like I have an existing portfolio, right? There are four, five such questions. What should I do with my existing portfolio? Do I sell the tax impact of that, or do I rebalance? I think that is one question that I've seen three or four of our guests post. And the second question is, I think you can correlate both of them together and answer, is that I have an existing portfolio. I have some surplus. What should I do today?
Yeah.
So I think
Uh,
rebalancing and allocation.
yeah. So, one on rebalancing, this was a lesson taught to me by my guru and my mentor, which is uh, if you know there's a mistake in your portfolio, correct it yesterday, right? And I think it is extremely important. See, mistakes also compound, right? And they negatively compound. I think we only think about positive compounding, but there's also negative compounding that happens. Uh, Please do understand that any mistake should be corrected, right? Uh, and it's exactly like how life is. If I have gone overweight by 10 kgs because of Diwali, I should correct it right away, right? I should not wait for a year saying ki, okay, I will slowly do it. I'll slowly cut my diet. It is exactly the same thing in money management, which is as soon as uh, if you know that you've made a mistake, right? And it's completely okay. I mean, to err is human indeed.
I think Shumil, I'll just double click on that. I think what our guests sort of, and having done this role for a long period of time, the cost of right, because obviously when you rebalance, right, given the markets how strong they have been last 4 years, there have been decent gains in the portfolio, right? And if somebody's portfolio is 60, 70 funds or 78 to 100 stocks, decent gains in the portfolio, the cost impact, right, the tax, how do you take into account that and still take the decision to sell, pay tax, and so I just wanted you to double click on that.
Here, see again, tax, frankly, tax is a assured liability, right? It's not a probabilistic liability, it's an assured liability. I always would strongly recommend that if there's a tax and it's a mistake, then you're lucky, right? How many times do we make mistakes and we still make profits, right? Tax comes from profit. If and frankly, every all of us know when we've made a mistake, right? If somebody has 50 funds and you're still sitting on capital gain, trust me, you're lucky, right? Trust me, you're lucky. Let's not ride the luck for too long, and let's correct these things. It's like I'm sorry, but I'm going to go back to Diwali example again. You ate half a kilo of sweets and you still not have put on weight. You're just lucky, right? Doesn't mean you should eat another half a kilo of sweets. So I think my humblest submission to all of you is don't worry about paying tax on capital gain, right? Worry about the capital gain going away, right?
Yeah.
Sometimes, and I have made this mistake so many times, saying that if I held this stock for one more month or 2 more months, I will pay long-term capital gain tax and I don't have to pay short-term capital gain tax. By the time it became long-term, there was no capital gain, right? So I think please do not be scared of the tax. Be scared of the capital gain.
Sure, then the second part of the question, right? If I have an existing portfolio, I have some cash, which is intended to go towards equity. How do I deploy that today?
Again, going back to your, so obviously the first thing is we would strongly advise that we invest into equities. Within equities, depending on how your portfolio is and how well you can take drawdowns. I think these are the two most important questions that you need to answer. which is, let's say if your portfolio is 70 large cap, 30 mid and small cap, there is an opportunity to make it 60/40. But if you already have a lot of small and mid cap funds, then the opportunity is to add some large caps. That is number one. Number two is volatility. Please do remember small and mid caps give uh, higher returns over the long term, but they are more volatile, right? So if I showed you the Nifty 500 uh, 1 year, 3 year, 5 year rolling returns, if I had shown you Nifty small cap, it would be much more exaggerated, right? So I think please do remember that small and mid cap, and very very simple again, right? I'll probably try and venture out to explain the why of it. It happens because these companies are smaller, right? Again, you're buying companies. A smaller company, if there's an economic shock, it takes more time to adjust, right? So very simply, let's say tomorrow we have some issue with the textile tariff, right? A company with one factory and 100 people, which is let's say a small company, will find it much more difficult to adapt to it than let's say some of the largest companies that India has, right? Very simply, think about it like that. It's not because they always say that a company doesn't know if it's small cap or mid cap, right? So a company's wherewithal is what takes time to adjust to the shocks.
Yeah, I think so. You're right because you're talking about mortality rate, right? Mortality rate in mid caps and small caps of the company sort of going bust, right? In listed space is much higher versus large caps, right? I think Sushmin will take one last question. This is a repeated thing. No, what is the IPO market today, right? And how do you see it? How does it affect the current market, the fresh flow of paper?
Uh, I'm extremely happy that we have more and more companies coming up for IPO and getting listed. Uh, in the long run, a market's maturity and a market's attractiveness comes from the varied nature of companies that get listed, right? I mean, when I started my career, all you could buy was five banks, two IT companies, one Reliance, and that was pretty much what you could do. Today, you could buy all the way from Urban Company to now Lenskart and HDFC Bank and whatnot, right? Like, I think it is amazing for our markets. It is amazing for all of us as investors to have these companies listed in our stock markets. The most encouraging thing for me is people who actually never wanted to list in India. Just for your knowledge, there's so many companies. I don't want to name them, but they were incorporated in Singapore and the US because they thought Indian markets will never be suitable for them to get listed, right? They are now paying 500 crores, 600 crores, 1,000 crores to what they call flip back and want to list in India, right? I mean, LG to list in India, Hyundai to list in India. I mean, these are just like marquee events for our markets, right? Like phenomenal marquee events for our markets. Uh, I would say it's a sign of the Indian public markets is probably the second best in the world, right, after the US. Having said that, whether you should invest in IPOs, not invest in IPOs, please, 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 if you spend 10 hours analyzing a public company, you have to spend 100 hours analyzing an IPO, right? Because there is no track record that is available to us except one document, which is the IPO document, right? We don't know how they behave in public markets. We don't know how they handle quarterly calls. There's nothing that we know. Again, we were taught that, very, very famously, Mr. Junjunwala said once that I don't invest in IPOs, right? It's my only advice is be careful, do a lot more research. Uh, you know, uh, if you just want to apply and get some allotment and flip it, trust me, there's a lot of effort. You don't make too much money out of it because you pay full tax. And see, these are, I mean, a lot of people invest in IPOs because they have heard the story ki I bought Wipro. My father or my grandfather had Wipro in the IPO, or Hindustan Lever in the IPO, or Infosys in the IPO, and see what wealth it's created. that is not going to repeat, right? Because those companies came in at 100 crore value, 100 crore market cap, 500 crore market cap.
Yeah,
These
yeah,
companies are coming at 70,000 crore market cap,
yeah,
right?
yeah, yeah.
So please
Yes.
be mindful. Do a lot more research. I'm not saying for once that you should not invest in IPOs, but do a lot more research. Almost 10 times the research that you have to do has to be done on a IPO.
No, Shubham, thanks so much. I think the only thing that markets keep teaching us is how complex it is, right? The more I spend time in markets, the more I think we realize that we don't know anything. And I think that's sort of one of the key takeaways. I think we should wrap this up, Sushmit. I think we sort of have already crossed time. I would thank all the guests who have taken their time out to join the call. We want to do this on a more regular basis, give you more analytics, more know-how what is happening on the markets, and give you practical solutions that onto questions that you have on a day-to-day basis, right? So I thank everybody for joining this call and appreciate your time. Thanks so much. Thank you, Sushmit.
Thank you. Thank you, everyone. Thank you.